Look at the headlines. There are widespread fears over inflation and calls for more hikes because of the conflict with Iran. But Warsh views legacy metrics like CPI and PCE as backward looking. They lag by weeks, meaning the Fed often makes policy choices based on old data. His goal is to track live market data to respond more accurately. Historically, geopolitical supply shocks cause an initial spike in energy. Here's how it works. While central banks may adopt a hawkish tone during a crisis, high energy prices and war-related uncertainty act as a natural economic brake. Consumer spending slows down, and corporations manage costs, which naturally tightens financial conditions. Because demand softens, these temporary energy spikes rarely bleed into core wages and services. Instead, the economy cools down first. In the past, central banks sometimes over-tightened by relying on lagging data, hiking rates just as the economy was already slowing down. With a real-time data approach, the disinflationary impact of falling oil prices and a cooling economy shows up in the models immediately. This provides a clear justification against over-tightening, paving the way for a policy shift. He is introducing the trimmed mean inflation metric. Warsh noted that analyzing inflation requires a more refined method than simply separating core from non-core items. His new inflation framework task force plans to focus on trimmed mean (CPI), which removes extreme outliers, the highest and lowest temporary price spikes, to average the rest. This approach filters out short-term energy shocks from the core calculation, allowing policymakers to see if inflation is broad-based or just a temporary anomaly. By focusing on this metric, Warsh signals that he is cautious about overreacting to temporary price spikes.